Yep. So you mean your yes.
I need.
You need to sign something? Is that what I don't have anything for you to sign,
Okay.
but I just check here.
Okay.
Here.
This week I come in at Tuesday, but after the Spring Festival, I need
Okay,
back to
sure,
the
sure.
Thursday start.
Oh, okay. Alrighty. I'll print out like a sheet next time, then you can
Okay.
sign it.
Okay.
All right, thank you. Yeah. Testing, testing. Okay, I think it's. All right, welcome to week 3. Today's agenda is the following. I will go over the quiz reviews. So I had a mixed results from your last week's quiz. I think the main problem was people were confused which country to assign as the foreign country. So the hint was that if you know how the exchange rate is defined, domestic divided by foreign, then you know which country should be R star and which country should be R. And once you have that established, it should be clear which R to plug in which, and then with that you can check solve for F, etc. But I think a few of you switched the countries and therefore got the wrong answer for the second question, I think, and therefore I need to make sure you guys get that, because I think it's very, very easy question if you ever see that on like a CFA exam, and you shouldn't make that mistake anymore after today. All right, so go over the quiz, a few Q&A questions that I got questions from students, so I'll answer that, and then I'll go over the triangular arbitrage again. So I think some students every year gets confused on how to solve this, and so I'm going to try to focus on the intuition, which is what's most important. And I think once the intuition is established, it should be quite straightforward how you should approach the question, which steps to take, which route to check, and then it should be quite easy to figure out if there's an arbitrage opportunity. And then I'll go over the integrated problem set number 2. So again, the problem set number 2 is just a review of the concept that you learned from last week, namely covered interest rate parity. and then try to, again, give you some intuition what CIP is really about. And then, of course, give you some variations on how the question could be asked on exam. For example, in this class during lectures, I'm only talking about 1 year interest rates. But if I give you compounding stuff, things get a little bit more complicated, but not too complicated, right? And so it's just review of stuff you learned from last semester, and then just combining stuff with what we learned this semester. And then today's topic is our transitioning from CIP to what's called the uncovered interest rate parity, which is our formal expected returns model. So from your previous semester, you must have learned an expected returns model for stocks, right? And maybe for bonds, for risky debt. So this class, we need to come up with an expected returns model for foreign currencies. But we need to impose a few assumptions to make it tractable for our purposes, which is how to be able to forecast where the exchange rate should change given certain news announcements, right? That's kind of our goal. So we need to impose two assumptions, specifically risk neutrality of investors. That's number one. And number two is efficient markets. So you must have learned the efficient market hypothesis, right? From last semester. This semester, basically the same thing, but we're going to be focusing on a very specific idea called rational expectations, which is the assumption that the markets are efficient in aggregating information. And if you believe that's true, if it's efficient and then it's able to aggregate all relevant information, whether it's private or public, then markets on average should be able to predict the future quite well. You can already tell that that's quite a bad assumption, but that's what efficient market hypothesis entails. Okay, we are going to assume that markets are good at aggregating information. Therefore, on average, markets should be good at forecasting the future prices. And if that's so, then there should be some type of investors that should be okay with not hedging against future spot exchange rate, right? So that's the key idea. We come up with a reason for why people won't engage in a forward contract, and we have to specify the risk preference of these investors such that they would undergo, a carry trade strategy and leave themselves exposed to foreign exchange rate risk, future exchange rate risk. All right, so that's our objective today, is just to go over the assumptions, how we move from CIP to UIP, and then explain to you how the mechanism of market clearing works for the Forex FX market under those assumptions, and then try to visualize it with graphs. All right. Some people learn with math. Some people will learn with intuition and words, and some of you learn with graphs. So I'm giving you 3 ways to understand FX determination, and hopefully that should cover the universe of people here in this class. Okay, so let's go over the quiz. So the quiz questions, 2 questions. The first question is just a review of your intuitive understanding of reading quotes, right? Reading exchange rate quotes. So the question states the following: if the exchange rate is valued at, for Canadian dollars, goes from 0.6 US dollars to 0.8 US dollars, then the Canadian dollar does which of the following, or has done which of the following. So just based on what was written here, we know that we're talking about the value of the Canadian dollar, which is the denominator. That's the foreign currency we're thinking about. And the numerator is therefore USD. So domestic currency is US dollar. So the price of a foreign currency goes from 0.6 to 0.8, which means that the underlying asset here has gotten more expensive. So 2 implications. You can say this implication in 2 ways. Number one, you can say that the Canadian dollar got stronger, right? In which case it requires more US dollars to obtain the same quantity than before. And the other way is to say the US dollar has gotten weaker, in which case again, same logic. We require more dollars to buy the same amount of Canadian dollars as before. All right, so my description should fit one of the options here. So the Canadian dollar has appreciated, which is what I said first, right? The other ones, nope, right? The Canadian dollar did not depreciate. It has appreciated because it requires more US dollars than before. All right, and Canadians will find US goods cheaper. Yes, all else equal, if prices haven't changed and Canadian dollars can buy more US dollars than before, then they can buy more goods, all else equal, right? So I think that's the two bullet points here. The price of Canadian dollars in terms of USD has increased, and therefore Canadian dollars appreciated and USD depreciated. Yeah, I think almost everyone got this question, and so I'm not going to dwell too long on this. But again, this is just practicing your understanding of the terminology, right? So appreciation, depreciation. Appreciation means you can get more than before, right? Or requires more to buy something than before. Sorry, it requires less than to buy something than before. And depreciated means your currency has gotten weaker and you need more of it to buy the same amount of assets or whatever than before. Okay, so that's question one. Question two is when things got a bit tricky because people didn't get the proper way to approach this question. So let me read the question first. Suppose the 1 year nominal interest rate for the US and the European Union are 10% and 9% respectively. So just based on that sentence, you don't know which country is R and which country is R star, correct? So EU, I'm treating EU as a country, okay, even though it's just a trading bloc. They have, so hopefully up to now, you should realize that the entire several countries in Europe use the same currency, right? And so they set the single interest rate for the entire country. The region. All right. So if the spot exchange rate, which is defined in this way, the price of dollars in terms of euros is 0.8, the normal arbitrage 1 year forward exchange rate is closest to which of the following. So we define the spot rate and the forward rate in this way. And we should all know based on last week's lecture how to read this, right? USD is the base currency. That's the foreign currency. So therefore, USD is going to be our R star, and EU is the quote currency. You can assume therefore that we're Europeans, and therefore that's our home currency, and we're thinking about pricing the foreign currency, which is R star, USD. Okay, so based on that, it should be easy, right? So we know the equation for CIP. It's here, right? We just plug in 10% for R star, right? 10% for R star, that's here. 9% for R. And F and E are defined again with US dollars being the foreign currency and euro being the domestic currency. And solve for F, right? That's the definition of no arbitrage 1 year forward rate, right? No arbitrage meaning that if this parity is violated, somebody can make something from nothing, right? No risk, no investment, you get infinite money until, the parity was restored. So solving for F, just algebra, just double check that it's somewhere close to 0.7925, right? Which is your A, okay? So that's how you do it. So the key, of course, is to figure out how the spot rate is quoted, how the spot or forward rate is quoted. It should be quoted in the same units. Once you have that, then you decide which country is foreign, which country is domestic, and then you assign R and R star to those countries, right? And then check CIP. Once you figure out how CIP is violated, for example, then you know how to construct your arbitrage strategy, right? How to outline it. Or check whether or not the parity is satisfied. Or in this case, solve for F. Okay. All right. Comments, questions on question 2? So yeah, once you have this down, like a typical question I would ask obviously would be like, these are the quotes. This is the quote. Of course, I'll give you something more complicated like the homework assignment, like here. But the idea is I give you some numbers. You need to check something's violated, and you need to outline the trading strategy. Yeah, right. That's something that I can easily ask on an exam. All right, so I received 2 questions. I think they're good questions, and I think it's related to the stuff you learned from last semester. So it's a good review and to make the distinction from what we talked about today and what was talked about in the past for you guys. So the question I received was, how do you interpret the forward premium? And it's really the second question, which is, how is that different than the return on a forward contract, right? Forward return. I think you learned that in your previous semester. So I'm going to tell you what the difference is very soon. But let me tell you how to interpret the forward premium. So the definition of the forward premium in this class is F minus E over E. And the way to interpret this so-called premium or return is just think of F as the expected future spot rate that the investor thinks is going to, take place in the future, right? So if F is equal to, for example, ET plus 1, or 1 is 1 year from now, then F minus E over E is the expected return of the foreign currency in terms of domestic currency, right? Or the expected depreciation of the home currency. So that's how you should think about the forward premium. In terms of the CIP, this term is basically saying that this is the amount the home currency needs to depreciate in order to wipe out any sort of profit you can make from interest rate differentials, right, between countries. If there's not enough, right, if there's not enough depreciation of the home currency or appreciation of the foreign currency, then somebody can make something from nothing. There is arbitrage, right? That's what the forward premium is defined in this class. All right, so again, let me emphasize here, it's the additional return on foreign currency deposits needed so no arbitrage is possible. And the proper way to think about this as of now is it's the expected depreciation. So it's an average. It's the beliefs about the markets of how this future of the spot rate is gonna come about in the future. All right, we don't know what that is, but there must be an average value, and that's going to be represented by F. So there is a term for this substitution between F and expectation of E, which is I write here, F equals expected value of ET plus 1. So hopefully this notation is not foreign, right? So E just means I'm taking the average across all possible realization of future E, whatever that may be. So it's just like expected stock returns. We're talking about foreign currencies here. So F equals expected value only if we believe that there is unbiasedness in the markets, meaning that information is efficient, essentially, right? If information is efficiently aggregated by the markets, then we can safely say that forward markets are rational and they capture all beliefs, and taking the average will give us some accuracy about what the future spot rate should be. Okay, so that's how you should interpret the forward premium. Okay, something like this, these 2 bullet points. Okay, so how is this different from the forward return? So the forward return is not a real return, but I'm sure in your derivatives class it should be defined as the return in which you are engaged in the forward contract, but you turn around and you go to the markets to do something, right? So the example is if you're going to long forward, the return is turning around 1 year from now or sometime in the future and selling the underlying for something, right? So if you pay for it, if you're long forward, you're buying the underlying. So 1 year from now, for example, you will buy something. But if the spot price in the future exceeds what you pay, F, then you make a return, right? Which is defined as S or E minus F, right? So that's how the forward return is defined. So in other words, so let me write this here. So F minus, it should be defined as E prime minus F. That's how the forward return is defined if you're long forward. So if you're long, this is the price that you pay, right, for the underlying asset, and you turn around, you sell it on the open market 1 year from now or sometime in the future. The difference is your return on the forward contract. If you're short, you're hoping that the underlying asset is going to drop in value. You would receive F for delivering the underlying assets, but you have to buy it back, right? So F minus E prime, again, E prime, the prime indicates future value. We don't know what that is, but the return, if we were to calculate it 1 year from now, would be F minus E, right? Again, short means that you're betting that the future spot rate will be low so that you can buy it back and cover your position at a lower price than what you receive for delivering the underlying asset. Okay, so that's different, right? This is different from this because there's no E prime here, right? There's no E prime here. It's how F is defined. F is defined as the expectation of the future E prime. But here, it's the difference between E prime and F. So this is, I think, what you learned last semester, maybe. If not, we'll talk about it again, the last third of this class. It's different than here, okay? So this is like stock returns, right? We're thinking about stock returns, but instead of stocks, we're thinking about foreign assets priced in domestic currency. So F is just our representation of what future price should be. Okay. All right, so a note that when you engage in a forward contract, it costs you nothing, right? This is the fundamental of derivatives. It's just a side bet. It costs you nothing to initiate these contracts. And therefore nothing is exchanged today. It's only you do the exchange sometime in the future, right? Which is why our final payoffs look like this. Okay. All right, so whatever I wrote here is exactly this bullet point here. So I hope this clears any sort of confusion people may have. So this is different. This is different than the return you get on the forward contract. This is using the forward contract to proxy to substitute for future price of the foreign asset, the foreign currency, right? So again, good questions, just clarifying the distinction forward return versus forward premium. All right, comments, questions on the quiz and or the Q&A questions? All right, so I want to spend just a little bit of time reviewing triangular arbitrage because again, I think this is new and it's specific to foreign currencies. It's not something you typically see in stocks and bonds. So I'm going to show you how I approach it, and you are free to borrow it or not use it. It's up to you. I'm just going to highlight the intuition of doing it my way. And it's up to you to experiment and confirm what I tell you, and then use whatever method you end up using to solve the questions, triangular arbitrage questions. All right, so I just basically copy and pasted the slide from last week here, and I'm gonna try to explain my approach. So whenever I see a table like this, I will usually just look at the two base currencies that's shown in this table, right? One is USD and one is pound. All right, it's just arbitrary. I'm just gonna start my trading strategy by either borrowing US dollars or borrowing pound in this case, and then try different routes. Okay, so step one, I'm gonna identify two base currencies. So let's just call it A and B. Okay, this doesn't matter which one you start with. So let's just pick one, and let's construct a chain of conversions that loop back to the base currency. So that means going from A to B to C to A, right? Which is this route. And then from last week, I hopefully convinced you that this route will yield the same conclusions if you start with B or you start with C, as long as the ABC chain is the same, right? ABC, ABC, ABC. As long as that chain is the same, then it doesn't matter which currency you start with, you'll get up the same. The difference here is one route could be borrowing the quote currency, but the way I like to start, I like to borrow the base currency, right? That's what I like to do. Oh. Okay, so borrow the base. If you borrow the base, the idea is the following. You want to borrow something so that you can sell in the market, or the implied quote that yields a higher quantity than the other way, the direct way, and then try to buy back using the direct quote. So that's like selling high and then buying low, right? Buying at the low price. That's the idea. So, okay. Yeah, so if a currency conversions yield more than what you started with, which is what I said, you either sell high and buy back low, or you buy cheap, sell expensive. They're both the same idea. You will get more than what you started, right? If not, if you don't get more than what you started, you try the other route. So rather than going from A to B to C, you go from A to C to B and then circle back. And again, going this route, you get two other routes that yields the same conclusion. So you only have to check one case if the other case doesn't work, right? So total, only two scenarios to check, ABC or ACB, right? All right, so this is the same as last week. So let me explain again how it's done. So I borrowed the base. So the base here is US dollars. So I borrow dollars. And I want to convert dollars for, in this case, euros. So I look for euros in which I can buy, in which I can use dollars to sell or use dollars to buy. So in this case, it's dollars to sell. That's why it's sell here. Sell tells you that I can only sell at a crappier price, which is the bid, which is why you see this number here. Okay, this is the bid. After going from euros, we move on to pounds. Pound and euro is this quote. And because we have euros and the base is pounds, we're going to use euros to buy pounds. And when we're buying stuff, we have to buy expensive, right? So that's this quote. And finally, going back, we go from pounds to dollars. So here we are selling pounds for dollars because pounds is the base. And we can only sell pounds at the crappier price, right? The lower price, the bid price here. So that's why these numbers show up here. And again, the idea is that this set of transactions going from USD to euro to pounds gives you an implied exchange rate between pounds and USD, right? Going from USD to euro to pounds could yield something that's completely different than this direct quote, right? And the idea is that if the gap between the implied quote and the direct quote is large enough, there could be ways to make more than what you started with, right? Okay, so let me explain again intuition here. My preferred way is to borrow the base. The intuition of borrowing the base is you're borrowing this currency and try to sell it as expensive or as high as possible, right? As for as much foreign currency, for as much of the quote currency as possible. So here, when we sell to euros and we buy for 2 USD, hopefully that will yield a amount of pounds that's much larger than what you could get from this quote here, right? That's the hope. If you get more, then I think this quote, right? If you get more than this quote by large amounts, then you could get something from nothing, right? Because this is the conversion rate back. If you get more than 1.465, then you can buy back more, right? You can buy back more than what you started. So sell high, buy low, and again, we're comparing the implied quote, which is this sequence of trades, to the direct quote, right? This is on the row 3, right? Row 3 of the table. So that's the intuition. The intuition again, trying to borrow currency, sell for as much of the quote currency as possible. Hopefully that amount is larger than the direct quote. And so when you convert back, you get more than what you started. So all we're doing is comparing the direct implied quote to the direct quote. And so in the first bullet point here, we're talking about USD to pounds and pounds to USD. All right, if you don't like borrowing the base, that's fine. You could borrow the quote. That's also okay, but the intuition is more or less the same idea. You borrow the quote and you try to use that currency in which it's the strongest and against the base currency. So you want to use this currency in which it is the strongest against the base currency. So you want to buy something, the quote currency, as cheaply as possible, right? That's when the currency is stronger, right? So borrow the quote, you buy cheap, and you try to turn around and sell as high or expensive as possible, right? For what you bought. So again, the first sequence of trades is when you're trying to buy, you're trying to use the quote currency to buy something, right? Namely, to buy USD as cheaply as possible, and then turn around and sell USD for euros for as expensive as possible. And again, it's the same idea. We're comparing an implied quote. In this case, we're borrowing the euros. So if you decide to borrow the quote, you can borrow the euros and converting to USD through this intermediary currency, right? Pounds. And then comparing it or exchanging it back to our original currency through the direct quote. Okay, that's it. The same ideas, right? Same idea, but slightly different interpretation. But you can think of it just as the same. They're both the same. You're just trying to buy low and sell high, or vice versa, right? Okay, that's the intuition. Comments, questions. So I gave you my method, which is to look at the base, start with the base. With the base, I think the intuition is very straightforward. You borrow and you try to sell for as much as possible. And hopefully that implied conversion rate will give you more than what you started. So when you convert back, you get more than what you started. That's the way I do it. If the route you check first doesn't work, so if A, B, C to A, or B, C, A to B, C, A, B to C yields less than what you started, there's only one other thing you have to check, right? Is swapping the B and swapping one of the sequence, right? So if it's A, B, C, you just swap B and C, right? But you don't have to swap that. You can swap something else. But in any case, just swap one pair of currencies and check that route. If that doesn't work, then there's no arbitrage, right? The markets are rational, and you can't make something from nothing. All money is taken off the table, right? There's no free lunch anymore. If one way works, then you're done, right? You're done. The question that I will typically ask is there arbitrage opportunities? And if you identify one, you're done. Okay. And then you outline your strategy, and that's it. All right. So the thing that you have to pay attention is just the bid and the ask. So you have to know the sequence. If you know the sequence, then you know when to use the bid, when to use the ask. You use the bid when you have to sell something. You use the ask when you have to buy something, and that's it, right? Just be careful for that. Cool. All right. If no other questions, I will cover the problem set from last week. So the problem set is the following exercise. So I gave you another triangular arbitrage setting, a much easier setting in which there's no bid and ask quotes anymore. It's just a single quote. So things are much easier. So that's just practice. And then I gave you a covered interest rate parity question, but it's a bit tricky because you have to do some conversion between annual compounding to semi-annual compounding, but it shouldn't be too hard. But just note that this is finance class. I expect you to all understand how to do this conversion. And the last question is just intuition of what the Ford, the CIP is really about. It's really about pricing the forward contract. And if you don't find a F price in the markets, you can construct it synthetically, right? As long as you're able to borrow currencies across two different borrow at certain interest rates across two different countries, you can construct a synthetic forward price, for any time horizon. So if you want a forward, so usually forward prices only go up to maybe up to a year, and maybe up to 5 years for foreign currencies. So if you want to do very, very long-term forward contracts, you can, even though it's not quoted in the market, you can still construct an F yourself by engaging in bank deposits and borrowing for very long periods of time, 10 years, 30 years, whatever. Okay, it's possible. So I'll show you through this question how it's done. All right, so let me read you the first question. Suppose you are a trader at the foreign exchange rate desk at Goldman Sachs in London, and you observe the following exchange rates for euro, British pounds, and US dollars. And you have the following rates. And I wrote it here that the base currency is quoted first, followed by the quote currency. So this is the price of pounds in terms of euros, the price of US dollars in terms of euros, and the price of pounds in terms of US dollars. And you're supposed to start from, you're supposed to construct your arbitrage, triangular arbitrage, starting from, let's see. So if you start from euros, okay? So we go from euros to pounds to dollars and circle back to euros. That's what we need to check. Okay, so very straightforward question. So let's go ahead and see and highlight the intuition here, right? So objective, euros, pounds, dollars, euros. Okay, that's what we need to check. Intuition, buy low, so high, or so high, buy low. Okay, that's the big idea. So the question tells you to first borrow euros, namely 10 million. Okay, use that to buy pounds. Okay, so we start with euros and we're going to pounds. So we have the quote currency here. And now we're buying the base currency with it. So that's going to be 1.1555. Okay. So that's how you read it. 1.1555 euros will buy you 1 pound. And then after going to pounds, we're going to do something to the pounds to get dollars. So what do we do based on the quotes? We sell the pounds for dollars, right? Because the base currency is pounds here. So sell the pounds. That means dividing by the price. So 1.1555. And then, sorry, we multiply by 1.5386. That should give us dollars. Yes. So I wrote it this way because I wanted to factor out the 10 million, take out the 10 million, and then construct the implied exchange rate from these two quotes, right? Again, just to highlight what the implied quote looks like and how that looks like compared with a direct quote. So if you just calculate this ratio, 1.5386 divided by 1.1555, you will get 1.332, okay? That is the implied exchange rate between euros and dollars of 1.332. So in other words, the price of euros in terms of dollars, right? You can see that because dollars is in the numerator and euros is in the denominator. Okay, so that's so far, should tell you something. But if you want to see it more explicit comparison, we just take the inverse, right? Take the inverse. That will give us the price of dollars in terms of euros. That will give us 0.75. And if we compare it with this quote, there is a discrepancy, right? 0.75 is clearly different than 0.76. And it's the same exchange rate, right? US dollars, the price of US dollars in terms of euros here. And we also have the price of US dollars in terms of euro. So two different prices for the same asset tells us must be arbitrage, right? USD is cheaper via the implied FX rate, okay? So taking advantage of this, we can just go from this step here, right? This step here, and sell it at this more, this better price, right? 0.76388, right? We sell it at this better price, in which we got it at 0.75. We turn around and sell it at a higher price. Obviously gives you something that's greater than 1, right? And so this term is greater than 1. So something greater than 1 times 10 million, right? So this entire thing. Something greater than 1 times 10 million must be greater than 10 million. So we're done, right? So again, of course, you could have done this much quicker. You didn't need to do all this stuff, but the whole point of walking through this is so that you see where the arbitrage is coming from, right? It's coming from comparing the implied quotes to the direct quote. All right, comments, questions on this first problem set question? All right, the second question reads the following. The euro spot exchange rate against the US dollars was 1.2834 USD per 1 euro on this date, while the 6-month forward exchange rate was this price per euro. All right, so we have a euro. So we have our exchange rate of where the dollar is the numerator and euros the denominator, right? So on the same day, the Wall Street Journal reported 6-month euro dollar. So euro dollar, you will probably see this all the time. Euro dollar just means US denominated deposits that are located in Europe. So in Hong Kong, you can deposit US dollars here in a bank and earn interest on it. Okay. I don't know the name. I guess it's euro Hong Kong dollar, something like that. But the whole point is that you can get foreign interest on your bank deposits, even though you're in a foreign country. Okay, You can get foreign bank interest, even though you're in a different country. So Eurodollar is US denominated deposits located in Europe. That interest rate in this problem is 3.125 per annum. And I assume that is compounded annually. So what you need to solve is, what was the effective euro deposit interest rate for 6 months in percent per annum? And just ignore any sort of bid-ask quotes. All right, so let's summarize the information that's given to you. So we have the following. We have spot rate of $1.28 per euro. We have a forward rate, but it's 6 months. So 0.5 is half a year, right? So 6 months is half a year. That's why I wrote that there. That's the forward rate, okay? You have domestic interest rates of 3.15% per annum, compounded annually. And you're trying to solve for R1 such that CIP is satisfied. Right? The problem, however, is your forward rate is at 6 months and your interest rates are at annualized, right? So what we need to do is try to convert the annualized interest rates to the periodic interest rate of R 0.5 and R star 0.5. Okay. So first things first, identify the domestic country and identify the foreign country based on the quotes of the spot price and the forward price. US dollars the domestic, euros the foreign. So our R is USD and R star is euro. Yes. How do you convert from annual compounding to semi-annual compounding? Well, you just use the idea that you can reinvest your bank deposit 6 months, right? And that's how you get compounding for half a year. And that should equal, assuming the law of one price, to the return you get for a single year return, right? This must be true if you allow a person to roll over their investments, right? After 6 months, they put their money back in the bank account, compound again. That should give you the 1 year return. Solve for R 0.25. So you take the square root, right? That's 0.25 exponential. So all we're doing is calculating this. That should give us this. And we can calculate this too, which will give us this, right? This one will give us this. Substitute everything in, right? We have R1, we have R1 star. We just move everything to one side and solve for R1 star. You should get something like 4.1%. Okay. Simple, right? So as long as you have annual compounding, it's very easy to, talk about forward contracts that are semi-annual, quarterly, monthly. It's very easy, right? Just instead of to the second power, it's to the fourth power, to the 12th power, etc. Right, so not too hard, but it requires you to think, to be careful with the numbers. It's possible that if you just forgot that half a year is not the same as 1 year, you could get the same conclusion, but it would be imprecise if we're talking about a trading strategy. All right, so you could say like there is arbitrage, but it's imprecise. All right, so not too bad, right? So if you see a question like this, just be careful. Read the question carefully. You are finance students, so you should be very familiar with converting compounding frequencies. And we're going to be working with very simplified model because, again, intuition is most important. If you get the intuition down, this is just minor details. And this is what separates, careful students for less careful students. Okay. All right. Third question. Now, rather than triangular arbitrage having bid and ask quotes, we have bid and ask quotes for interest rates as well. And we need to also consider this possibility because bank deposits, you can think of bank deposits as bonds as well, right? So we'll get to that soon if you don't believe me. But yes, most bank accounts checking, savings deposits, they are backed by money market, some sort of money market portfolio. And you can think of this money market as a bond price. And if there's a bond price, there must be two sets of prices. And if there's two sets of prices, you should get two sets of bond yields, right? So same idea. Okay, so in this setup of the question, you have current quotes on Japanese yen and US dollar exchange rates and interest rates. And you're supposed to find and describe the arbitrage opportunity if possible. And the rest of the sentence just describes to you what bid and ask price means. So we talked about that last week. Okay, so US dollar, it's listed first. The dollar is the base currency. Second currency code is JPY. That's the quote currency. So all these prices are in yen. Yen, 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 and yen. Okay. 3 month. Okay, 3 month forward, and we have a spot. So remember, CIP must hold for all investment horizons. Okay, so if this is 3 months, then we must check for 3 months interest rates. Okay, so this is the 3 month interest rate, but is annualized and assumed to be compounded annually. So we need to, again, be careful. We need to convert these interest rates so that they are the periodic interest rates that matches this F, the time horizon, this F. Okay, so 1.3125%, 1.4375, etc. These interest rates are all annualized. So we need to de-annualize them and convert compounding to quarterly now, right? We need to do quarterly now. Okay, so this is just review. For prices, the market maker wants to buy at the bid price, and they want to sell at the ask price. And it's the same thing for interest rates. If they want to lend to you, they're going to lend to you at the more expensive price, right? And if they're going to let you invest in them, if they're going to borrow from the investor, they want to let you borrow. If they only want to borrow the lower price, so the bid price is the price at which the market maker is willing to borrow, and the ask price is the interest rate the market maker is willing to. Sorry, the bid price is the interest rate the market maker is willing to borrow from the investor, and the ask price is the interest rate the market maker is willing to lend to you, which is at the higher interest rate. So same idea, right? The market maker wants to screw the investor over. So that's how you remember which interest rate to use. All right, so how do we do the conversions? Just like before, we convert the annualized to the quarterly now, right? So we are given APY, so that's annual percentage yield, okay? And this is the APR. We're given, sorry, this numerator here is the APR, and we divide it by 4 so that it becomes a monthly interest rate, right? That's just definitions. So we want this, right? We want to solve for this term here, right? Because this is the 3 month periodic interest rate, and we are given APY, right? And 3 months is a quarter of a year, and there's 4 quarters in every year, so which is why we see a 4th power here, right? And so to solve for the 3 month periodic rate, you just move everything to one side, which would give you this. And so plugging in APY from all these numbers here, we can easily construct a new table which gives us periodic interest rates, right? 3 month. These are now 3 month periodic rates to match precisely the F, right? The 3 month F. Okay. So this is again the same idea as before, right? You allow the person to reinvest 4 times in a year. That should be equal to the APY yield if you were to just deposit and hold for 1 whole year. This has to be true because the cash flows are the same, right? Okay, so how do you tell which bid or ask price to do? Well, you figure that out by walking through the trading strategy, step by step, and then you fill in the gaps. Okay, so for here, I'm just gonna tell you ahead of time that it's gonna be violated this way, okay? This means that you're going to borrow the foreign currency and lend out at the deposit in the domestic currency. So that means we're gonna borrow, sorry, the other way around, sorry. It should be borrow the Japanese yen and lend to USD. So USD is foreign and borrow Japanese yen is domestic. So it's going to be violated in this way. Sorry, this way, right? Meaning that the R is smaller than R star plus F minus E over E, right? 1 plus F minus E over E. Okay, so how do we construct the trading strategy? We first borrow an amount. We know that in this case, in which the return on foreign interest rates exceeds domestic, we borrow, to make the math simpler, we borrow E value. But the question is, do we borrow at the bid or do we borrow the ask, right? That's probably what you're asking. We know we have to borrow E, but do we borrow E ask or E bid? Well, we can tell by looking at step 2, in which we have to turn around and use the amount we borrowed to convert to the domestic currency. So we have to buy 1 USD, meaning we have to pay the more expensive price, which tells us that in step 1, we should actually be borrowing at the ask amount. Okay, so that's how you tell. So remember from week 2, right? Week 2 or week 1, week 2, we learned that in the case in which R is less than R star, right? R star plus F minus E over E, right? That's the equation. When it's violated this way, you borrow domestic and you deposit and foreign. We all yes. So we borrow some amounts, so E, and we have to go and buy. We have to buy the foreign currency, right? But we don't know if we're buying at the bid or ask. Sorry, we don't know if we're going to use bid or ask until we look at step 2, in which we realize that we have to use the currency to buy something. So when you buy something, you have to pay at the higher price, which is ask. So buy 1 USD for the price of E ask, which means that our liability in step 1 must be E ask times 1 plus R, Japanese yen. Okay, so we don't know, now we don't know that it should be ask or not, but so we'll leave that blank, okay? Oh, sorry, we know. We're borrowing, so it should be at the higher price. So we know that too. Okay, so it should be asked. So let me start over, okay? So step 1, figure out how the CIP is violated. We realize it's this, which means that we're going to have to borrow domestic and deposit and foreign. So we borrow E amount, and we want to buy the foreign for using the E amount, but we don't know if it's ask or bid. Going to step 2, realize we're using that amount to buy something, which tells us it's going to be E ask. Great, but we have to return interest on that loan, and we must return at the ask price because the market maker wants to lend you at the highest interest rate as possible, right? Which is the ask price. So that liability will be due in 3 months. All right. Step 3, we have $1 and we're going to lend it out. And because it's a loan to the market maker is only going to pay us interest at the lower interest rate, which is bid. Okay. So we now have a liability of E ask times 1 plus R JPY. We have a asset return of 1 plus R USD bid in 3 months, but we are exposed to a risky USD return, right? This is foreign because JPY is domestic here. USD is foreign. So to eliminate that exposure, we can sell that foreign currency off for a known price today. So that would be this number times F, right? And the question you'd be asking is, should it be bid or ask? So because you are selling, you can only sell at the lower price, which tells you that F must be bid. Right? So short forward, short means delivering or selling the underlying asset. Buy means to pay for the higher price, right? So the ask. So we have this cash inflow, right? In step 4, and we now have only this cash outflow in 3 months. So as long as this inflow exceeds this outflow, we have arbitrage profits. So check the numbers yourself, and hopefully it should be this. Okay. So I'll leave it to you to do the other direction when it's violated this way. When R is greater than R star, you have to walk through again the steps, and then just remember, when you're borrowing at the ask. When you're lending at the bid. When you buy, you're buying at the ask. When you sell, you're selling at the bid, right? So I think everything is just reversed, but you should just double check. Okay. Comments, questions on 2.3. So the hard part is actually this. I think this is the tricky part. But if you got that down, then this is just a review of triangular arbitrage with bid-ask price, but now applied to CIP. That's it. Okay, cool. Let's move on to the last question. Implied forward rate. So I kind of mentioned earlier, right, that for currencies, foreign currencies, the futures market doesn't go out that far into the future. You can probably get up to 1 year with quite liquid. It's quite liquid to find a contract, to find a counterparty for 1 year. But if you want to hedge with a forward contract and that forward contract doesn't exist, you can still do it with just interest rates as long as they are the same time horizons. And the point of this question is to show you can construct a so-called synthetic forward contract by, again, doing a carry trade, right? Doing some sort of carry trade. Let me read the question to you. So suppose you are a winemaker in California, and you ordered oak barrels from France for your vineyard. All right, so you have to buy these special barrels to store your wine. You're a wine seller, and the barrels will arrive in 1 year. So you don't need the barrels now, but you want to buy them in 1 year. And they cost, and you know the cost. It's going to cost you 122 euros each. There is no forward contract, so you can't hedge against the price. You can't lock in the price today. So it's possible that the price of a euro could fluctuate, and therefore your actual cost in dollars is going to be different than what it is today. But you know the other following. You know 1 year euro deposit rate is going to be this 4.75%. And you know that the euro dollar deposit rate is 4.25%. So that's just the US interest rate. So your job is to describe the transaction to lock in a dollar price per barrel and calculate the price. You know the spot price is 1.2834. And we're just basically using the CIP to construct a synthetic forward contract. So it's maybe not clear without me walking you through how to derive it. So let's go ahead and derive it right now. All right, so here's the information, the relevant information that I picked out from the question. So you have the spot rate and the forward. There's no forward rate. You have US deposit, US being the domestic currency, US deposit rate 4.25%, and foreign euro deposit rate of 4.75%. And your objective is to lock in a future US price of barrels today. And you know the price in euros though, but you want to pay a fixed price that doesn't fluctuate in USD in 1 year. So you want to know the price today. How do you do that? All right, so the way to do this is to start from the cash outflow in the future, cash inflow outflow in the future, and go backwards. That's the intuition. So you know that you need 122 euros in the future to buy barrels. So that's an inflow. I'm going to interpret that as an inflow because I need this amount to buy a barrel. So per barrel, I need I need 122 euros, but I don't need it today, right? I only need it 1 year from now. And so if I could take advantage of bank deposits, I can figure out how much I need today so that I have enough 1 year from now. So take 122 euros and divide it by 1 plus R star interest rate. That should give you the amount I actually need today to deposit so that I have enough in the future, right? So if you calculate 1.22 divided by 1 R squared, you should get 116 euros. So again, that just means that I need this amount today, but in terms of US dollars, I can just multiply by E, which will give me the amount of dollars I need today. So multiplying by E, which is this quantity here, will give us 1.49 USD today. All right, so that's how much I need today. So I can have 122 euros 1 year from now. All right. Outflow. So I need to pay out F in the future. And what I'm going to do is I'm going to borrow this amount, right? This is what I need. So let's borrow it today, which means that I will pay an interest, principal plus interest of 149 plus 1 plus R, right? We can calculate this F, right? We can calculate this F now. It's 149 times 1 plus 4.25%. That gives us $1.56, right? So this is what I owe. This is what I owe 1 year from now. This is what I get 1 year from now. So 156 USD. That's what I pay, right? And what I get is 116. Sorry. It should be 122 euros in the future, right? So in the future, I'll have an outflow of 156 and I'll have an inflow of 122. So what is this? This is an exchange rate, right? Just normalize, divide everything by 122. That gives me an exchange rate. To be precise, it's a future exchange rate, forward exchange rate. All right, so that's the intuition for CIP. It tells you what the fair F should be based on interest rates. And this has to be true, as we know from CIP. Otherwise, you have a way to make something from nothing, meaning there's no risk. There's a way to make something with no risk and no investments. All right, comments, questions on the problem set. So I hope the problem set highlighted the key takeaways from last week, which was CIP has to hold, otherwise you can make arbitrage. Things get a little bit complicated when you have compounding, and also things maybe get a little complicated when you have bid and ask spreads. And now it should be clear how you should do these problems, right? Okay. If no other questions, then let me move on to today's lecture. So let's see. All right. So today's lecture, an asset approach to the exchange rate. Asset approach just means we are thinking about pricing exchange rate like a return on an asset, like stocks and bonds. And so when we think about asset pricing, we have to think about expected returns, just like stocks, expected returns. Stock returns are risky, right? Dividend payments are unpredictable. Same idea here. There is some dimension of uncertainty that needs to be somehow quantified. And then we need to make some restrictions on the type of investors and figure out what they care about so that we know how they react to changes in interest rates, for example, so that they maximize something. So that's the kind of idea. We need to design a model in which investors have incentives to do something when interest rates change. Okay. All right. So the objective, of course, is to go from CIP to UIP. And we need to impose a lot of assumptions, but I want to be clear first of what you typically think about when you think about an asset pricing model. So that's why I wrote asset returns, risk, and liquidity. So here, when you talk about CAPM, right, the capital asset pricing model, when you talk about other sorts of factor models, there's always, these things you have to account for when building the expected returns model. So the asset return is specifically referring to the average return of this underlying asset, right? When you do your CAPM model, right, you have a matrix of mean returns for every stock, but there are other dimensions that we also care about besides the mean return, right? Namely risk, right? How do you quantify risk? Well, in CAPM, we kind of imagine that every type of stock return is normal. And if that's true, then there's really only two dimensions to think about: standard deviation and mean return. But for pricing foreign currencies, we're going to make some assumptions such that this becomes irrelevant. Okay, so the preview here is that we're going to assume that investors are risk neutral, which means that the only thing they really care about is the average return. They just pretend that the risk doesn't exist. Okay, so the variability of an asset's return, so you think about it as in terms of the standard deviation or variance, right? This doesn't factor into an investor's wealth optimization problem. The reason is because they are risk neutral, right? And I'll get to an example what that really means. All right. Other dimensions that you might worry about are liquidity, for example, right? The ease at which an asset can be sold in exchange. If there's a liquidity premium, that should be part of the factor model. We're going to also ignore that dimension as well. So this is like a market microstructure explanation. This is the risk return trade-off dimension. So we're going to keep things simple. Okay. We're going to just focus on asset returns, which means it should be straightforward to transition from CIP to UIP, right? All we are doing is we won't engage in the F anymore, right? That's the idea. And just leaving the the E prime there in the model. So it's going to be stochastic, right? There's going to be uncertainty. It has infinite possible realizations in the future. And because we only care about average returns, simply taking the expected value of the entire CIP equation now is good enough for us, right? That's the idea. Okay, so let me walk slowly so that we're not lost. All right, so far we talked about returns, specifically interest rate returns. So this should be it should be trivial, right? Interest returns are deterministic. There's no uncertainty. When you put the money in the bank, we know for sure we will get R or R star, right? We're kind of, for now, assuming there's no default risk. There's no chance that a country will just, fail to bail out their banks. And therefore, R and R star are essentially guaranteed and risk-free. Okay, so the example I give you here, suppose interest rate is 5%. You deposit €1, then you should get 1.05 euros in 1 year, right? Super straightforward. However, the change in currency value is different now because there's uncertainty and risk involved. We don't know what future E will be. Like this will have a distribution, right? So you must have learned from last semester that probably there's some central moment, right? There could be fat tails, whatever, but we can characterize this distribution using the mean, right? Maybe this is the only thing that the investor cares about. That's the idea. And we can do that. And therefore we can just work with this expression here for the returns on foreign currency. So E hat E is my shorthand way of writing expected value of future E. Okay. So I'm writing E hat E for shorthand for the expected value of E prime. So let me write, I guess I should write that. This is expected value of future E, which is E prime. Okay. How do I get E hat E? Well, sorry, this is E hat E. So how do we get this? You can get this easily by just taking expected value of so let me go slowly. All right. All right, so review of random variables. I hope it's not too slow, but just in case. All right. So let's just make sure we're on the same page. So E is known. So E is known, right? That's the spot price, but E hat, E prime is a random variable. But we can know its distribution of values, right? Let's say we kind of know how it's defined. There are moments we can observe, namely the mean, for example. So for example, suppose we have a currency that's priced at E today, and let's assume that it's a binary world. Okay, so instead of a distribution, we just assume that there's only two possible realizations of let's say 1 or 0, okay, or just 2 or 1. And let's assume that the price is equal to 1, right? 0 0.5, 0 0.5, right? Let's assume it's 50-50 coin flip. It can either stay the same or it can go up. Let's just say go to 0, okay? Go up or down, right? You can either go up or go down. So given this, we know the distribution, we know the possible realization of values, we can actually calculate E hat E, right? Remember 2 is equal to E prime, and 0 can also equal E prime, right? It's possible realization of what E could be. It could either go up, it can go down, but we can calculate this because we know it's 0.5 up or 0.5 down. So 0.5 times 2, right? Plus 0.5 times 0, which is just what, 1, right? So if we want to, so that's simple, right? All right. So we can know the mean, right? And so given our expected returns model, if we just take the expected value of E prime minus E over E, then we can factor out the constant E, right? Multiplied by E prime minus E. That will give us E hat E minus E over E. So let me medium. Okay, and then I can enlarge this. All right. Yes. So I'm just applying the expected value definition, right? We can, if it's expected value, everything's linear. I can factor out constants, and the only thing that's really encompassed by the expected value function is just the randomness of E prime, right? And that's why we can just work with this as our returns model. So as if you recall from last week, right, we can work with a simplified model in which this is approximately equal to R minus R star, right? So that's our model. It's very simple, right? We need to define, so summarize again, we need to define the type of investors that only cares about expected returns, the average return of the foreign currency, after taking the expected value of the foreign return based on CIP after assuming we're not engaging in the forward contract, then what CIP tells us is that the average return of the foreign currency should be interest rate differentials between countries, right? So very, very elegant model, but it requires a strong assumption, which is we need to define the investor that only cares about expected returns, right? So you can tell that this is a very strong assumption because it totally ignores the variance, the risk, right? Where's the risk dimension? It's not there. So that's not good, right? Let me give you an example, but I'll give you a numerical one in a few minutes or in a few slides later. Imagine we have two different types of gambles. Let's say I give you two gambles, one in which you win $1 and one you lose $1, right? Has an expected value of 0, but the variance is defined as what? So the variance of a gamble that's 50-50 is equal to what? 0.5. Variance is defined as E minus the average E, so E hat E, right? Squared, right? And then you add blah blah blah, right? Again, 0.5. This is just definition of variance. I don't want to get too deep into this, okay? When the payoff is just 1 and -1, the variance is just variance should just be equal to, I think, so the average should be 1 minus 1, 0. Sorry, 2 minus 1. 2 minus 1 is just 1, which is 0.5. And then here it's 1 minus 1 is 0. So it's just variance of 0.5, right? For the 1 and minus 1. All right. Now imagine the same gamble, but instead of 50% plus 1 and 50% minus 1, it's 50% plus 1 million and 50% minus 1 million. The mean is the same, but the variance is totally different. But I'm telling you that if I assume risk neutrality, the investor doesn't care which gamble. He is indifferent. Okay. But in any case, I will give you a numerical example soon, but that's what we're going to impose so that we can just work with this asset pricing model, okay, which is called UIP, the uncovered interest rate parity. Okay. All right, that's where we're heading. Okay, so I hope I didn't lose anyone when talking about random variables, but all we're doing is just taking the expected value on CIP and assuming we don't engage in the forward contract, which means that E prime is just left, the investor is just left exposed to E prime. Okay, it could take some value that hurts them. But what we're doing now is just taking the expected value on both sides of CIP, assuming we don't engage in the forward contract. And that's the model we're going to be working with in the future. Okay, so then we can talk about average returns on the foreign currencies. And so we can say expected rate of depreciation for the home currency, if we're talking about E hat E minus E over E being positive, which means the foreign currency is on average most likely going up. That's what the market thinks it's going to do. And so if this is the expected rate of depreciation of the US dollar, then an investor with €1 expects to hold €1, should expect it to be worth 1 plus E hat E minus E, right? Because if the home currency gets weaker, the foreign currency gets stronger. And in terms of USD, it's going to be worth more than just 1 USD, assuming it's just 1-to-1, right? All right, so that's how you should think of this expression now. It's an expected return on the foreign currency, but we like to also say that it's the expected rate of depreciation of the home currency or expected rate of appreciation of the foreign currency. So it's just a return now, an average return on the risky asset, which is foreign currency stock. All right. So now I'm going to talk about the uncovered interest rate parity in detail. So we have this starting point, 1 plus R, 1 plus R star, 1 plus F minus E. And we know this approximated expression, right? We know this, how to do this. You just multiply everything out and just realize that the R star times F minus E over E minus E over E is approximately 0, right? In which case you can just work with this expression. So the reason why I like to write this equation is because when plotting, things look better. Okay, I mean, it's easy to understand what happens to the plot when certain parameters change. Working with this is a bit more complicated, and I think it confuses people. So I think this is a good enough approximation when plotting. All right, we know how this parity restores its parity. It's restored through the no arbitrage condition, which means that if there is a violation, speculators have incentives to come in and make money, right? Because there's no risk, there's no investments, you get something from nothing. That's the only incentive that's necessary for them to come in and restore parity. So that's a review, okay? Now things are going to be a bit different now. Now we're going to replace F with E hat E. Okay, it's called uncovered because we are no longer eliminating future FX risk anymore. So 2 reasons why we can do this, as I mentioned earlier. We can do this because we replace F for E, first of all, because we can assume efficient markets. As I stated earlier, efficient markets is not just about transaction costs, right? It's not about the size of bid-ask spread. It's not just about the ease of liquidating certain things. It's more than that. It's about information aggregation. So maybe in the previous semester you learned about price earnings, price drift, right? Stuff like that. Maybe you learned about merger arbitrage, in which after mergers, the price has needs some time in order to approach its fair value, right? These are inefficiencies, right, in the market, in which the market doesn't incorporate everything instantaneously. But when we have the efficient financial market assumption, it means that every information is instantaneously incorporated in the market price. Okay, any new information is all in the price. That said, that also means that different types of information is also incorporated in the price, which means private information as well as public information. All right. So if that's the case, if markets are efficient, if information is efficiently aggregated, then we can expect the market to predict the future quite accurately. In which case, we can say F is approximately equal to E hat E. This is called rational expectations. Okay, and it's an information story. Which I think it's not too far-fetched. Imagine if you know everybody's information sets, you combine everything about what they see in the future. On average, you should be pretty good at forecasting the future, right? And if that's true, and also in combination with risk neutrality, then there's really no reason for you to engage in a forward contract anymore, right? Because on average, people are pretty good at predicting the future because the market prices incorporates all information sets, private and public. You are risk neutral, which means that uncertainty doesn't matter to you, right? The variance, the spread of the distribution of how E could realize doesn't matter to you. You just care about the central moment, right? The mean. If you have the mean, that's all you care about, and therefore, this parity should hold, right? This parity should hold. If there's a violation to this parity, the incentive is you will come in as a risk neutral investor and maximize expected profits, right? And expected profits is just defined as the mean return, right? So it's just the analogous trading strategy as the no arbitrage version of CIP, right? You have to come in, your incentive is because you get free money, right? you come in and do it, and you do the trade, and you keep doing it until the parity is restored and no money on the table. But for UIP, the mechanism is the following, right? There has to be a violation in expectations. If there is profit in expectations, then you as the risk neutral investor will come in and try to maximize expected returns. And in doing so, you go through the same construction of your trading strategy, and that will close the gap until you get parity. Okay, so that's the mechanism. It's the same mechanism, but it's not because of free money. It's because you're maximizing expected mean returns. That's how you close the gap in UIP. All right, so if that's not clear, we will get to it visually at least, okay? So let me describe to you the different components of UIP. So you have gross return on USD deposits, which is 1 plus R. That's just deterministic, no uncertainty. Gross return on Euro deposits, that's the foreign currency, 1 plus R. That's also deterministic. Spot rate, the same as before. Now, the only difference is you have this expected exchange rate. And again, we focus on expected exchange rate because we're going to assume that we're dealing with risk neutral investors. So here's the description of what goes on here, all right? So suppose you have a violation in which the domestic currency bank deposit return exceeds the foreign bank deposit returns after expected currency conversions, after accounting for expected rate of depreciation of the home currency. If you see this violation, you as it's not the arbitrageur anymore, it's the carry trader, okay? So CIP, you have arbitrageurs restoring parity, but for UIP, you have carry traders. So what does that mean? You have carry traders coming in, borrowing at the foreign interest rate, converting what you borrowed to domestic currency, and lending out at 1 plus R, and that's it. No forward contract. You are intentionally exposing yourself to fluctuations in future E. Okay? But you'll keep doing this, right? You'll keep doing this because on average, you believe that you'll make money, because all that's required for you to come in is if the left-hand side exceeds the left-hand side on average, right? You only care about averages as risk neutral investors. So you keep doing this, you keep converting foreign currency to domestic currency. That's going to push up the price, appreciate the domestic currency, which means E goes down, and therefore the entire right-hand side will go up, right? The engagement of the forward contract doesn't do anything to the parity. It's the fact that you're converting one currency to the other that closes this gap. And the mechanism for UIP to restore parity is because you have some type of investor maximizing expected returns, and they keep doing this until, on average, they make nothing, right? They no longer want to conduct carry trade. So carry trade is defined as I hope you guys read the slides. It means to borrow low interest rates and lend borrow low interest and lend high interest rate. Okay? So to conduct a carry trade means you're borrowing an interest rate and then lending an interest rate. Okay? So CIP is arbitrageurs. So let me review. Violation of CIP. The only incentive to come in and close the gap, restore parity, is because there's literally free money on the table. No risk, no investments. You'd be stupid not to take the money. UIP is different. You're talking about people, it's not about free money necessarily. It's about, on average, free money, okay? Or positive returns. on average, positive returns. So conducting this carry trade means that they're doing the same thing as arbitrageurs. They're borrowing at the low interest rate, lending out the high interest rate, and they'll keep doing this until expected returns of this carry trade is equal to zero. And the reason why it approaches zero, the expected return approach zero, is because as they convert one currency to the other, the spot rate will change today, right? So the mechanism is, the mechanism is the same, right? You need people coming in to do something to the spot price. But the reason for doing it is different. CIP is because of free money. UYP is because there's positive expected returns when you engage or conduct a carry trade. So that's why in this sentence here, I wrote, this is not a strict no arbitrage argument. It's related, yes. It's just the different type of investors. We're talking about different types of investors now. All right, EHAE is not quoted anywhere. So I want to emphasize that this is not observable. Okay, this is not observable. This is beliefs. So imagine I can combine everybody's whatever you think about how the future price of certain currency in this classroom, we can't see, right? But that's somehow aggregated in the price today in the markets somehow. Okay, it's uncovered because there's no F, right? Our carry traders do not engage in forward contracts because they are intentionally exposing themselves to FX risk. Okay. In contrast to the covered interest rate parity, it of course will fail. Why? Because we're talking about averages, right? We're not talking about every single instance that has to hold, unlike CIP. CIP has to hold. If it doesn't, free money, right? We're talking about averages, which means that this parity, right, it's multiple instances, like over thousands and thousands of millions of observations, right? We consolidate that, we're saying that on average, it should be true. Okay. All right, so let's see. All right, so before we take a break, let me summarize our conditions that I repeated several times already. So number one, financial markets are efficient is a necessary assumption so that we can repurpose the CIP for an asset pricing model, meaning that we want to replace F for EHAE, right? We're assuming that markets are good at aggregating information. We don't need to engage in F. We can predict the future, and therefore that F is no longer necessary. Number two, we're going to assume investors are risk neutral. Again, highlighting the fact that if they're risk neutral, they don't care about F anymore because they only care about averages. Okay, and the variance is no longer part of the calculations in their portfolio optimization objective function, right? Yeah. So the example I gave you is imagine you have two gambles in which let's call it gamble one, gives you expected returns of it's 0.5 times 1 plus 0.5. All right, I'll type it out. So we have gamble one, expected returns, expected value is equal to 0.5 times positive 1 plus 0.5 times negative 1 versus gamble 2. Expected value is 0.5 times positive 1 million plus 0.5 minus 1 million. Should be the same, right? Because you're just taking an average of both sides, right? And it's symmetric, so the same mean, but the variance of gamble one is much smaller than the variance of gamble two, and you just use the variance definition, right? It should be clear. The variance explodes for gamble two. So very, very strong assumption here. But again, we care about tractability. That's also an important demand in economic and financial modeling. We want tractability. So that's what we're going to work with in this class. And we'll get to know it better after the break. So let's take a 10-minute break. I have another quiz for you. So I'll hand that out. And this is your another chance to do well and get some extra points back.
Yeah, personally, I have a question. For example, would the let's refer to the corporate disparity with us votes. So personally, I was wondering whether it could be calculated as we would like to forecast whether the forward rate of 3 months would be just as the same as the estimate as the real 3 month interest exchange rates. So we can really find where we find the spread or we find arbitrage opportunity with the participation of call and put options.
Call and put options
Yes.
using what? What are you trying to do?
For example, we can see that first of all, I just calculated the 3-month interest rate spread to be 0.985%. So I just calculated the 3 months exchange rate should now be 112.637, which is a number smaller than 103.8, which is what we can see in the ask price of the 3-month 113.8. So I first purchased the put option in 3 months. So I would like to sell yen at the strike price of the one.
Well, I didn't give you option. I don't, how do you know those options are available at that strike price? You just make it up? Just assume it's there? You're assuming that kind of option is available.
Yeah.
What if it's not?
So you mean that the call and put options market is not necessarily available in such?
Well, I didn't, well, I mean, what are you trying to do here? Just more arbitrage? More, what are you trying to do here?
So I just want to see whether there would be a differences of price in the real 3-month interest rate or 3-month exchange rates and the forward 3-month interest forward 3-month exchange rates. So if there's the difference of prices, there would be probably a opportunity in arbitrage. So with the participation of both the forward exchange market and call and put options market, I think that could be arbitrage.
Okay. I mean, I didn't give you that information, so, but I guess it could. Sure. That's it. That's their question? Okay.
我记得这次讲有天赋天赋这人是家是动物年。
All right, do you guys have questions? I hear a lot of discussion, so is there? Okay, so I don't know exactly the confusion, but I might want to highlight, kind of want to emphasize one thing. Arbitrage by definition is a guaranteed payoff. Okay, that's different than what carry traders are betting on. Carry traders are trying to make an on average something, expected profits, but arbitrage is a guaranteed payoff, positive payoff. So CIP, the way it's maintained is just based on the incentives that something that's guaranteed and positive is more than enough incentive for you to come in and take it. But UIP requires a type of investors that focuses on average returns. Okay, if there is, so you can already imagine a lot of ways UIP can break, and we'll talk about that the last couple of slides in this this lecture. Okay, about how it breaks down. The way to address this, of course, is to come up with additional risk premium factors and to augment it somehow. And we'll talk about augmenting this UIP equations maybe in week, I don't know, 7 or 8. Okay. So for now, we're going to assume, you know, in economics, we always take the extreme to keep the model simple, right? We keep markets efficient, we keep investors risk neutral, we assume everything's super simplified, and we try to price things that way. And then we try to break it. And when things start to break, we can start to think about how prices could change when things are not as efficient as we imagine it to be. Okay, but that's going to take several weeks before we fully have a fully functional model that incorporates macro stuff. And then we'll address the additional risk factors that could influence investors to conduct carry trade. Okay. All right, so I guess let's just continue unless there's someone is brave enough to tell me if there's confusion. Otherwise, let's just let's move on. Okay, so for the next part of this set of slides, I'm going to rely on the simplified version of UIP, which looks like this. Okay, so again, this is saying is that the dollar net return that you get from bank deposits must equal to the foreign currency net return and expectations, and the expectations come from the average return that you get from holding on to the foreign currency, right? If it's positive, that means the foreign currency will appreciate in value, or alternatively said, the domestic currency will depreciate in value over that investment horizon, right? If it's a 1-year bank deposit, then it's a depreciation rate over 1 year. The derivation is the same, just multiply everything out from this 1 period model, and you realize that a small number multiplied by a small number is basically 0, and so we can work with just this as an approximation. Okay, so with that in mind, we want to I want to highlight what the implications of this model really means. Okay, with over a period of time. So starting with this model, we can rewrite this model by moving things around. So let's go ahead and move R and R star on one side. So maybe minus both sides R. So it's minus R. That's where we get this here. And then multiply both sides by E. So we get the following equation here. And just based on this characterization, you can develop a relationship between the difference in interest rates and the difference between the spot rate and the expected future spot rate. E hat E is the expectation of the future spot rate And we're saying that what this is saying is that if foreign bank deposit returns exceeds domestic bank deposit returns, then the spot rate must on average be higher than the future spot rate, right? And I will show you what that means with a time graph, okay? So let's go ahead and look at two different scenarios, one in which R star minus R is positive, and also one scenario in which R star minus R is negative, right? It has these implications, right? If it's positive, then that means that the relationship between E and E hat E is positive. If it's negative, then it's the other way. Okay, so maybe I write the equation that I just mentioned up here so that we know what we're looking at. E minus E hat E is equal to R star minus R times E. Okay, so look at this graph. We have the x-axis as time goes from time equals 0, the time of bank deposit in which you put money in somewhere, all the way to maturity. So when you're going to take out the money. So I don't know, call it t equals capital T, right? So same thing on this side, t equals 0 to t equals big T. So for this lecture, let's just assume that E hat E is some anchor, right? It's something that we don't observe, but we know it's relatively constant because perhaps it's far, far away into the future, maybe 10 years from now. So in that sense, then our expectations, our beliefs, anything that happens today most likely won't persist all the way 10 years. Okay, this is a strong assumption, but let's assume that it's just some constant. So we know R star, we know E hat E is some constant, so it's an anchor, right? We just don't assume that doesn't change. And given this, we should know, we can determine E, right? At least we know when R changes or when R changes or when there's a discrepancy between R and R star, we know how where E should be, okay? So how do you characterize the anchor in a graph? We just draw a horizontal line, all right? So let's assume that this is our anchored beliefs about what E hat E should be. So the y-axis is the spot exchange rate value. So nominal, that's what nominal exchange rate means. It's just the spot rate, okay? And let's assume that E hat E is just here. Some arbitrary value, whatever it is. And let's also do that for here. So just some anchor, some constant. All right, so given this equation that I wrote here, let me step back a bit. We know this equation, we can rewrite it this way, right? We just move some terms around. And we're looking at the scenario in which R star is greater than R. If this side is positive, which is what this is saying, then this side must be positive, right? So what does a positive value here means? It means that if the E hat E is anchored here, then the spot rate must be up here, right? Today, correct? Today, if R star minus R is positive, and if E hat E is anchored, meaning it's a constant, nothing's going to change it. Anything that happens today is nothing's going to change it. Then E must be higher than E hat E, our anchor. Today. Do you agree? All right, so this gap here is R star minus R times E, right? Which is positive. So what rational expectations is saying is that if the spot rate is this today, and E hat E, the future value of E, is down here, over time, the spot rate must evolve towards E hat E. So that means as time goes from t equals 0 to t big T, this spot rate should decline in value until it's equal to our expectations. All right. So this is what I mean by rational expectations, or on average, we are correct in our beliefs about future E, which is E prime, right? Future E is just E prime. All right, said in another way, in a more equilibrium kind of argument. If we have R star minus R, if there's an interest rate differential between countries and carry traders want to exploit this, this differential is only possible if there is sufficient room for the spot rate, the home currency, to appreciate over time, right? So the interest rate return on foreign bank deposits can be larger than the bank deposit return only if there is sufficient room for the domestic currency to appreciate in value in equilibrium. Right? That's exactly what it's saying. Because if there is not enough, if E today is not high enough, then there is not enough for it to appreciate all the way to E hat E. Correct? So if R star minus R greater than 0, we must have domestic appreciation. Or in other words, E decreases. So this is a equilibrium argument, right? If it's out of equilibrium, carry traders come in, maximize expected profits, and restore parity, which means that the gap between E and E hat E must change, right? It must change when R, the gap between R and R star changes. And in the scenario in which interest rates, bank deposit rates in the foreign country is much more attractive than the domestic currency, then the home currency must get stronger to wipe out that differential on average. That's what it's saying. That's what the UIP is saying. And this is the visualization of that interest rate differential return wiping out, right? There is no difference between in returns between domestic and foreign bank deposits if the home currency is allowed to get stronger, right? Remember, E decreasing is the home currency getting stronger. So any sort of additional return on E star, I'm sorry, R star, the foreign interest rate, that additional return is canceled out by the fact that my liabilities, which is in minus R, is getting bigger, right, in relative value because the home currency is getting stronger. Make sense? That's what UIP is saying, okay? So the other direction, if we have R star minus R being negative, which is what this means, right? If this is negative, then E minus E hat E is negative. Then the question for you I have, should E be above or below E hat E? Below, right? It should be below because that's the only way in which E minus E hat E gives you negative, right? So on this y-axis, we have E hat E being anchored. And if some number is lower than this and it's subtracting this from this, from this value here, right? That's going to give us negative. So the opposite is true if the bank deposit returns at home exceeds bank deposits returns abroad. If there is a favorable interest rate domestically, then you should expect your home currency to depreciate, which means E getting larger over time. So you should expect it to go from here all the way back to here, right? So this gap is, again, R star minus R E times E, which is negative. It's negative because we're E minus E hat E, right? E minus E hat E is negative. And so if there is a way to exploit interest rate differentials between domestic and foreign in favor of domestic, then the opposite is going to happen compared to the left-hand side. The liability side is going to grow in value, or alternatively said, the returns you get on domestic bank deposits is going to be much weaker because the currency is going to depreciate, right? When E increases, that's depreciate, right? Depreciate. All right, so let me write that down. If R star minus R is negative, we must have domestic depreciation. E increases. Okay. And again, this is the way it works is because on average, we are correct about our beliefs. And if markets are efficient, then we have rational expectations, meaning we're pretty good at forecasting. That's what it means. Okay. All right, comments, questions on how to interpret UIP? I mean, what I said is almost the same as CIP, right? But we're just talking about rather than talking about guaranteed returns, we're talking about averages, average returns. And when we're talking about averages, we want to know how that average came about. It came about through our expectations about the future. And if the markets are efficient, then our beliefs in aggregate should be pretty good at forecasting. And therefore, we should expect the spot price or the price of the foreign currency today to move in the direction of our anchored expectations, right? All right. Now let's go ahead and characterize UIP on a graph in which the x-axis is now interest rate, domestic interest rates, and the y-axis is the spot rate, the spot exchange rate. So this is for those of you who don't like the math and don't like the English. It's fine. We have visual representations of UIP, and this is how we're going to represent it. So let's write the equation here. It's R equals R star plus E hat E minus E over E. So you can kind of see the direction of the relationship between R and E just by varying E from one side and see how R changes. So perhaps it's most obvious if we take R and make it super, super small. So if we make R basically 0, let's just say we just decrease R. That's only possible if something changes on the right-hand side. If R decreases, then we need to find some way to make this lower as well. If we can't change R star because it's not on the axis, and we can't change E hat E because it's an anchored expectations, then something has to change in E. And that change must be in the direction that allows us to go down, right? Decrease the right-hand side. And that's only possible if E increases, right? So just based on that sequence of logic, there should be a negative relationship, all else equal, between domestic interest rates and the spot rate, which makes sense, right? Because as you have interest rates as close to 0, it's as if the central bank has injected tons of money supply in the system, devaluing your currency relative to other foreign currencies, and therefore E should be very, very high, right? Much higher than before. Remember, a higher E means a weaker domestic currency. So this negative relationship, we typically write a downward sloping curve or draw a downward sloping curve. And the idea here is that each point on this line represents whether or not the E is very high or very low. So this is a very high E, right? Very weak, right? In other words, very weak E, domestic currency. This is a slightly weak currency. And perhaps this is a strong currency and a very strong currency, right? Very low E. So maybe you felt the effects already. As US increases its interest rates by a lot, that means they're unwinding their QE, their quantitative easing, and as a result, the US dollar gets strong, very strong, right? And that's bad for Hong Kong because that means that Hong Kong, in order to maintain its peg, it has to continue to buy up sell their reserves, right? They have to sell their reserves. Anyways, I'll talk about that later. Okay, so hopefully you understand the relationship between R and E graphically through this graph. So let's go ahead and now understand how the equilibrium comes about. It comes about when interest rates, which is set, we assume interest rates are set by the central government. When interest rates intersect with this UIP curve. Okay. Again, remember UIP is defined as R equals R star plus E hat E minus E over E. And this R is determined by the central bank because they control money supply. And therefore, the equilibrium exchange rate is simply the intersection of interest rates and the UIP curve. So this is E. Let's call it E naught for a starting point. So I write E0 usually for a starting point because I have to change it sometimes, okay? So you're kind of already getting at what I'm going to do, right? We have UIP. UIP is our condition that allows us to price foreign currencies. We want to eventually extend the model to incorporate the money market, which is the market that determines interest rates. You can already tell where we're going, right? And then eventually we're going to try to extend that model to incorporate how real goods and services determine interest rates, okay? And therefore, we have a full, complete picture of the economy and its exchange rate. So for those of you who don't like to work with the math or writing it, this is a graphical solution to find E, right? So finding E is not that interesting, okay? But in forecasting, when we see people talk on TV, when we read news articles, we want to kind of digest qualitatively what the central banks want to do, right? Where the economy in general is heading, and that only really requires us to determine the direction of where E should go, right? And so this graph, it can easily help us understand where E should go depending how R changes. For example, if we say central banks are considering monetary contraction, right? They're increasing interest rates. When R, for example, shifts this way, we know where, at least graphically, without thinking too much, where the spot rate should be, right? So we kind of expect E to go down, right? So that's my task now. I'm going to walk you through an analysis in which we change R and kind of explain to you how equilibrium is restored and why it has to be restored in 3 ways. One through the math, one through verbal argumentation, and then the last way is through graphs. So let's consider the following exercise. Let's now increase USD interest rate. So this is the home interest rate. This is domestic. So in this class, if I ever give you a question like analyze this graphically, you should always start with an initial equilibrium. Right? So that's what I'm going to do. Suppose we have a starting point in which interest rates were fixed beforehand at this point here, and we have a starting UIP curve. I'm going to write the UIP equation here. And we have this as our starting domestic interest rate. And just based on this starting point, we have an intersection. this point here, and that's going to be our initial E naught, our starting E naught, the zero indicating as our starting equilibrium. So the point of this exercise is to understand, all right, what happens if some variables change? What is our new equilibrium going to be? So step one, I mean, the first way, let's just look at it graphically. So if we were to increase interest rates, we just shift this curve to the right. We have a new R, let's call it R prime because it's a new level of R, domestic interest rates. How do you solve this graphically? Well, just look for the intersection. The intersection tells us that's the equilibrium point. And therefore, our new equilibrium spot rate should be lower, meaning that we should have a much stronger domestic currency than before. So E prime. All right, not very interesting, right? Because there's no, I didn't tell you the intuition. There's no economics. It's just visual. So now we want to understand why that's true. So let's look at the math. The math is here, right? The math is here. So what's going on? What's going on is the following. You have R increasing to R prime. You have UIP being violated. In which direction? In favor of the domestic interest rate, right? When you have this, and UIP must be restored because of those two assumptions, risk neutral investors plus efficient markets, then carry traders will come in and maximize expected returns and tries to close and will close the gap, right? That's only possible when they borrow foreign currency and buy domestic currency so that they can lend out at the higher interest rate. And in doing so, from converting from foreign to domestic, something must happen to the spot rate, right? It must go down, right? Because a lower denominator means a higher overall value on the right-hand side. And so the entire thing will increase until you get parity, right? Which is exactly what happens, right? E naught goes to E prime. So two ways to solve it already. One, look for the intersection point graphically. The second way is to work through the math. Think about what carry traders do, how it impacts the spot rate today because of the carry trading. And the third way is to just walk through the equilibrium economic arguments, right? So domestic appreciation today, why? So fixed expectations in the future, that's the first step. Step two, notice that the interest rate differential with greater returns on the domestic currency, right? So foreign, so this is acceptable. Sorry, this is acceptable in equilibrium only if equivalent capital loss in the future, domestic currency. And then realize that capital loss must wipe out interest rate differential. Right, that's the economic argument, right? You have expectations being fixed, it's anchored, you have rational expectations, you have an interest rate differential, right? Now that's greater than the expected depreciation of the home currency. That's not sustainable because carry traders will come in. So that means that something must happen to the spot rate so that there is enough room for the currency to depreciate. And that's only possible assuming expectations are anchored if the domestic currency appreciates today. So I know it sounds counterintuitive, but that's the story. The story is that the domestic currency has to appreciate today so that there's sufficient room to depreciate in the future to wipe out those interest rate differentials. Right? All right, summarize again. 3 ways to explain what's going on here, right? First way is to look at the graphs. The graphs tell you the intersection of those 2 lines between interest rates and the UIP tells you the equilibrium, acceptable equilibrium points for spot rate E today. With R moving to the right, the new intersection point must be a lower E, right? We know that. So this is divorced. This is no intuition whatsoever, just graphical solution. All right, mathematical solution. Look at the UIP curve. Realize that if domestic R increases, that means that the interest rate differential between R and R star is larger than before, which means that there is an inequality. Knowing that carry traders maximize expected returns, you know that they'll come in and try to conduct carry trade, but in doing so, by converting foreign currency to domestic currency in order to lend out, right, to make deposits in domestic currency, the E must change in that direction that favors the purchase, right? Because they're buying domestic, E must get stronger today, right? And parity will be restored once expected returns of carry trade is wiped out, 0, right? That's the math. All right, if that's not clear enough, you can walk through the equilibrium argument, right? The economic equilibrium argument. Expectations are anchored. You have interest rate differentials, but the differential has increased. This is unacceptable because the original expected depreciation of the home currency is too small to wipe out the interest rate differential. So something has to happen with spot rate today in order to make up for the gap, the additional gap between R and R star. That's only possible assuming anchored expectations if the home currency appreciates today so that there's a wider room, there's more room for it to depreciate in the future. All right, so that's an increase in USD domestic interest rates. We can, of course, do other exercises such as let's change the foreign currency's interest rate. So R star is changing. So let's go ahead and analyze this scenario. So as I mentioned earlier, the way to do these kind of analysis is you have a starting point. So let's go ahead and draw an initial UIP curve. Let's draw a starting point home interest rate. Let me write R equals R star plus E hat E minus E over E. And let's have a intersection here at E naught. And let's think about how things work. So the way to think about graphical solution is that if I change a variable that's not on the axis, then the curves must change. All right. So for example, in this plot, I noticed that R star is not on the axis, right? Because the x-axis is R, the x-axis is R, the y-axis is E, so something has to shift, all right? So let's choose an arbitrary R for now. So let's just fix an R. Let's call it this point here. And let's now increase foreign currencies interest rates. So based on this equation here, we have foreign interest rates increasing, which means that the inequality is now this way. This is not an acceptable equilibrium because carry traders come in, blah, blah, blah. So what must happen today is that E must change in the direction to offset this increase in R star. So E actually has to increase, right? Which decreases everything on the right-hand side. And so what this is saying, in summary, is that an increase in R star must lead to an increase in E. So holding R constant, I'm jumping up to this new point here, right? Some higher level of E, right? But we realized that the choice of the R to begin with was arbitrary. So I can choose any R. So no matter what R I choose on the UIP curve, I can choose any R. I must have a higher level of E if I decide to increase R star, right? So the entire UIP curve shifts upward, is what I'm saying. Okay, so our new curve is like this. And the new equation should be, let's call it R star prime to designate the higher R star value. And that's it, right? So graphically, if you know the math, it's easy to visualize. So visualization, what happens is UIP curve shifts up, new intersection at a higher level, and therefore our spot price must be higher than before. The foreign currency must be more expensive. All right, solving mathematically, we already did that, right? Because if R is greater than R star plus E hat E without changing E, then carry traders will come in, they'll borrow the domestic, lend out at the foreign currency, and when they convert domestic to foreign currency, they have to sell domestic in favor of foreign, which means that the domestic currency is getting weaker, which means that E must increase, right? Sorry, E prime here. All right, so that's the math. That was the graph. Now let's talk about the economic equilibrium argument. Domestic depreciation today. Fixed expectations. Greater interest rates on foreign currency deposits. Only acceptable equilibrium if interest rate differential is wiped out, and that's only possible if there's a capital gain on the domestic currency. It's a capital gain because we know that in the future, the new E prime has to decrease in value towards E hat E, right? Because we didn't change our anchor, right? Our expectations. So again, the non-intuitive explanation is the following. What happens is that there needs to be less room. There is too much depreciation in the home currency given the interest rate differentials between domestic and foreign country. So there must be a shrinkage, right, of that E hat E minus E over time. That's only possible if E changes today, right? Namely, E has to increase today so that you get that additional capital gain. All right, comments, questions on changing R star, how it impacts E. So now you can kind of already read the news and kind of know how it impacts exchange rates, right? All that stuff that happened during COVID pandemic about central banks cutting interest rates, what happens to the foreign currencies, what happens if one country cuts interest rates more so than the other country. You should know what the final outcome on the exchange rate between those two countries, and you can make predictions, right, with this model. Okay, so the last thing, I won't go through every explanation, but I'll walk you through just the math and the graph for the case in which we have change in expectations of the future spot exchange rate. So again, have a starting point, have an initial R. This one is R star. R equals R star. We have E minus E over E. Okay, let's walk through the math and then do the graph. So if we hold interest rates constant, so let's suppose nothing changes here, but the anchor E hat E increases. So if this increases, then the entire right-hand side will be this way. The inequality will favor the right-hand side now. This is not sustainable because carry traders want to take advantage of it. Namely, they will borrow domestic, invest in foreign. They will be converting currencies from domestic to foreign. So selling domestic, which means the domestic currency will depreciate in value, right? So E must increase so that the entire right-hand side decreases. So repeating myself, we've chosen arbitrary R, supposes this R. If there is an increase in E hat E, the spot rate must increase. So choosing any R along this line, we must jump to a higher point, right? So the entire curve shifts upward. So let's just call that R equals R star plus E hat E prime minus E over E. Okay, I use the prime to indicate a different value, a higher value. And we have therefore E prime, and this is E naught. All right, so I'll let you walk through the equilibrium argument of, depreciating today so that there's room to appreciate in the future to wipe out any sort of capital gains. Sorry, wipe out the interest rate differentials, right, between R and R star. All right, so end of this week, I will post a case studies where your job is to investigate whether or not CIP, UIP holds in the data. And all this information is calculatable. And you'll get, I think I'll ask you to get the data from the Bank of England. So it's all readily available and easily testable, okay? And what you'll find, what you should expect to find is that CIP is almost always true, which should not be surprising, right? Because the only assumption for CIP to hold is that there's free money on the table. As long as there's free money, there's no reason for anybody not to take it, unless there's some liquidity issue, but most likely among major developed countries, should not be an issue. UIP, on the other hand, should fail empirically often, and you should confirm this yourself, okay? Why does it fail? For obvious reasons, right? Reason number one, markets not efficient. Markets not efficient. Something wrong with aggregating information, right? That's number one. Number two is risk aversion, right? Meaning that there's some risk factor that's not being accounted for in the UIP equation. And we'll talk about that. So we'll try to incorporate default risk in the UIP model end of week 7 or 8, okay? So I list you some examples here. So here, there is a risk premium in the currency returns beyond mere interest rates. So that's here, right? There's additional risk factors that matter, like default risk, that we'll try to account for, okay? Number two, information is not processed efficiently. So imagine there's private information that cannot be aggregated by the markets. People just withhold the information. People don't trade on it. If people do not trade on it, then markets won't know about it. It won't be captured by the price. If that's the case, then definitely E hat E is just wrong, right? It's just incorrect. Another explanation, expectations may assign small probabilities to large devaluation that can cause tests to go wrong. Again, something wrong with E hat E being not accurate. And lastly, exchange rates may contain bubbles or there may be regime shifts. So again, something wrong with, this is all saying the same thing. Something's wrong with information aggregation, something wrong with E hat E. All right, comments, questions about CIP, UIP, how to visualize it. I will review one more time before we call it a day. All right, so my final comment before I review, how efficient are currency markets? So there seems to be, of different opinions about international exchange rates. So Alan Greenspan was the Fed chairman for a long time in the 2000s. So he's the one who's responsible for the 1990s economic boom of the US. And he was very laissez-faire, very market-oriented guy, and he believes that markets were very, very efficient. So he states, my experience is that exchange markets have become so efficient that virtually all relevant information is embedded almost instantaneously in exchange rates to the point that anticipating movements in major currency is rarely possible. All right, so based on your experience with corporate finance, you know that that's totally untrue, right? Just look at merger arbitrage, looking at price earnings drift, all that's price under IPO underpricing. All of these things are examples of markets not being able to process information efficiently. And there's no different, most likely no different for FX rates. So Alan Greenspan, I think, gives too much credit to efficient market hypothesis. If you want a proof of it, you can look at these index funds that try to conduct carry trade among a wide range of between wide range of countries. So the Deutsche Bank G10 Currency Futures Harvard Index tries to replicate currency carry trade between countries and try to make positive returns. And just based on their performance, there are instances between time periods in which they made substantial amount of positive returns, which means that most likely you could make something, right? You could make positive expected returns from carry trade, whereas efficient market says that's impossible on average, right? It should be zero, but depending on the window, it seems like it's possible to make on average positive returns from carry trade. All right, so that's today's lecture. So let me summarize what we learned today. So this is what we did today. We started with reviewed the covered interest rate parity. It's called covered because there is an engagement of the forward contract which eliminates future FX risk, right? There's no exposure to any risk of fluctuations of the currency value. And therefore, if you were to construct a carry trade and also engage a forward contract, you could end up with arbitrage profits, right? If there was a violation of CIP. And it's intuitive because it's really just the law of one price after accounting for both spot and future risk. And all it's saying is that bank deposit returns domestically must equal in value to foreign deposit returns after currency conversion, right? That's all it's saying. And therefore, you can interpret this F over E as just a return, right? An expected return on holding onto the foreign currency. So a positive value means that the domestic currency depreciated in value, which is saying that the foreign currency has gotten a premium, right? A premium to holding onto it. It's holding onto it. So this interpretation actually helps us transition to the UIP because if you think of F as some way to approximate future E, then we can just simply specify the conditions in which F and E prime and expectations are substitutable, right? And those conditions are the following, right? We have to assume risk neutral investors, which means that the mean return or the average return is all that matters. So higher mean is always preferred. Higher mean is always preferred, even if the variance is higher, okay? And that's number one. Number two is efficient markets. So efficient markets, namely, we have information symmetry. Information symmetry just means there's no difference between private and public information. The markets can capture all information sets, and in doing so, people are on average pretty good at forecasting the future value of E, okay? So rational expectations. This is very different, right? This is very different than CIP because the only condition for CIP to hold is that there's no arbitrage. As long as there's no arbitrage, CIP must hold because there's no money on the table, no incentive otherwise. Whereas UIP, we're talking about average returns. We need to have the conditions in which there are some type of investors that are willing to come in and conduct carry trade and close the gap, right? Close the interest rate differential. So expected returns of foreign currencies is equal to the interest rate differentials is our way to interpret UIP, right? Because R minus R star is equal to E hat E minus E over E, right? That is our asset pricing model for foreign currencies. Expected returns of foreign currencies must equal to interest rate differentials on average, right? On average. So far in this class, in this lecture, we're not going to be we didn't change E hat E specifically. I didn't tell you how it changed, right? For now, just assume that E hat E is an anchor. With that in mind, we can now just use this model to predict how E should move, given our other changes in our other parameters, R and R star specifically, right? So given that E serves as an anchor, our beliefs of the future are fixed. And given that anchor, we know that E must move in the direction towards E hat E allows equal, okay? And if UIP is true, then the way the interest rate differentials are positive or negative will tell us how E will evolve toward E hat E, right? So if domestic interest rates are favorable, more favorable than foreign interest rates, then we know that there must be future domestic depreciation, right? So if you'll have very good, so what this is saying is that if you can't have something that's too good to be true, right? If you have favorable interest rates domestically, then your domestic currency must lose value over time too. So you must have domestic depreciation. Conversely, if you have foreign interest rates being more favorable, again, it can't be too good to be true. So you must have foreign currency depreciation, or alternatively said, domestic appreciation to wipe out that extra interest rate return on deposits. Arbitrage, arbitrage should be in quotes, okay? It should be carry trade works through E, right? Because depending on which side of the interest rate is more favorable, the carry traders will borrow that side and lend out on that side. It's not arbitrage because they're still gambling. They're still gambling on the average returns. So they're exposed to risk. There is risk. Arbitrage specifically is referring to free money, right? No risk, no investments, get something from nothing. Yeah, so R and R star are taken as inputs. E is going to be some unknown constant, but that's okay because we just we're just concerned with forecasting as of now. So therefore our conclusion is that on average, changes in foreign currency returns are due to changes in E, which comes from changes in R star, right? Because expectations anchored, changes in R and R star, therefore E has to change with respect to that equation, right? All right, so last thing I want to highlight is the explanation of how UIP, the mechanism in which UIP is restored. I think the most intuitive way is the trader's viewpoint because you don't have to think too much about equilibrium. It just states that carry trade on average is profitable, right? Because if there is a violation, that means that I can short an interest rate, go long on an interest rate, and then on average, I'll probably make some money. And the way it's restored is because of the currency conversion. You convert the borrowed currency to the currency you're lending out. That act alone will change the domestic currency appreciation or depreciation, right? That's the mechanism. The alternative explanation is an equilibrium argument. So we say that if UIP holds in equilibrium, then any change in the interest rate differential, there must be an offsetting effect coming from domestic currency depreciation. If the currency depreciation is not enough, there must be a change in spot price E today, so that it's either large enough or smaller than before to match the interest rate differentials, so that we're back at equilibrium again. Okay, so the counterintuitive explanation, right, that confuses people, I think, is the fact that the currency has to move in the direction today, and that's opposite of the direction it has to move in the future, right? That's what might confuse you. Okay, so that's all I have for you today. So if you have comments, questions, please ask them now. Otherwise, you can take the rest of the 8 minutes to finish your quiz and turn them in. And see you guys next week.